Sometimes one chart can tell a story that the market isn't really talking about. Right now, something unusual is happening in the Treasury markets. Yields are moving higher, but the real driver may surprise investors. We're going to break down what's behind all of these moves, how it connects to the expectations of Fed monetary policy, and what it could mean going forward. Right now on UBS Trending. Hi, everyone, and thanks for joining me. I'm Anthony Pastore. This is UBS Trending. For our monthly spot, we've got Leslie Falconio joining us again. And Leslie, there's really a lot to unpack here. Good to see you, by the way. There's a lot to unpack. We're just coming off of a Fed meeting from last week, Warsh's second meeting. Lots that he said during, more importantly, the press conference afterwards that wasn't even in the much shorter statement than versus what Powell's Fed was releasing. I wanted to ask you, when you looked at what came out of not only the statement, but Warsh was saying during the press conference, and then you were watching the action that was happening on the Treasury market side, fixed income side, what did you take away? How did that all come together, and what did you see that the bond market was interpreting versus what Warsh was talking about?
Well, I mean, Anthony, it's interesting because when you think about what the probability of a hike was coming into that meeting, and as you know, that was not our expectation. We did not expect the Fed to hike, but the market was pricing in over a 50% probability that they would hike, in this July meeting. And we know under the former chairmanship, right, that more than likely wouldn't have occurred. Either something would have come out in the Wall Street Journal that adjusted the market's expectation, and, that sort of hawkishness, if you will, wouldn't have been as predominantly priced in as it was. So the statement in and of itself, as you mentioned, there really wasn't that much of a surprise there. Obviously, there was three dissenters, which, I mean, shouldn't be ignored. But frankly, if it just stopped there with, okay, you paused, you didn't hike, and you had these three dissenters, no, the market probably would have reacted, okay, you're not going to go today, July, but you're going to go in September. Again, not our call. But the market would have just reacted that way, and it would have been a much more of a calm reaction than what we saw. Instead, it really was, to your point, the time during the Q&A when the market really started to establish this volatility. And as I've always said, Anthony, it's not just about the level of rates, but how quickly you get there, that velocity, that has the impact to performance, whether it's equity or fixed income. And as you know, after that Q&A, yields rose. I mean, month over month, you had Treasury yields rise like 27 basis points. The curve, what we call twist steepened, meaning that long end yields went up and the short end yields came down, right? So you had the steepener. And frankly, it was because, particularly in that back end, because the focus, particularly in June, was on the price stability mandate, right? And meaning that, this isn't a Fed that just looks at the demand side anymore, or looks at the supply side, that it's not just about, the Middle East crisis, but it's about whether or not we hit that 2% target. And the focus is on that 2%, inflation target by Chair Warsh. That what happened was the market took that as, okay, wait a second. You just said this was really a focus. You didn't hike. So that back end said, you need to start compensating me now. So what we saw was break-even inflation expectations all of a sudden rise, right? And as inflation expectations rise, that 30-year yields start to rise. So you saw a really large move in the Treasury market, and you also saw a shift in how the market is pricing that Fed policy going forward, meaning that the fixed income market was, pricing several hikes in 2026. Now it has one hike in 2026 in December. Again, right now, that's not CIO's call. We think they remain on hold. And they have another hike priced in June of 2027. And again, Anthony, as you know, right now, our view is they remain on hold until well into 2027, where the next move is a cut, not a hike.
Right. Yeah, there was as you just kind of went through, Leslie, thank you for taking us on that journey, because there really was a lot to unpack. We heard Warsh say that the Fed was doing this watchful thinking instead of any urgency to hike. So there you go. That was when the market was kind of like, wait a minute, back it up for a second. That's not what came out of the statement. So yes, there really was a lot to unpack. But we did see, just before I walked in here, I was looking at the action in Treasuries from the statement all the way through Friday of last week. Well, we're sitting here filming the week after. The 10-year Treasury yield hit a high that we hadn't seen since January of 2025. Since then, it's come back down a little bit. That was related more to the continuing back and forth between Iran and U.S. with the conflict there. So when you're looking at, say, just generally rising real yields and the move that we've seen recently across treasuries, what message is the bond market actually sending about overall economic growth and inflation? And by the way, just to remind our audience, we think here at CIO that we're going to see more disinflation, meaning that we'll see prices rising, but maybe at a bit of a slower pace. So given all that, Leslie, what message is the bond market sending?
Yeah, absolutely. And Anthony, not only are you seeing 10-year Treasury yields the highest since, January 2025, but the 30-year yield at, 525, 527 is the highest since 2007. So when you think about like real yields, the way real yields have been acting, and that's real yields are the nominal minus the inflation expectation. What real yields were doing is that real yields were rising, okay? And real yields were rising more than break-even inflation expectations. And the caveat, and the important part here, is it was doing this when oil was going up, right? Because at that point in time, the conflict was actually, starting to re-engage again. So I have oil moving higher, but inflation expectations coming down. Why is that? Because the market was expecting the, committee to sort of look through the current crisis as being transitory, if you will, and actually hike. Because the probability or the expectation was you want to get to that 2% price stability. So in that sense, you saw real yields rise. And part of it was because the terminal rate of the Fed fund was going higher. Growth, as you mentioned, was doing a bit better. But once they didn't, okay, and once they actually didn't pull the trigger and hike, the market was saying, okay, well, maybe this price stability mandate is not necessarily the pure focus. After, he kind of stated vaguely, it'll take several years to get down to that 2% target. And what happened was inflation expectations moved higher, as did that long end. Now, it's been our expectation, that, in the second half of the year, the curve is going to steepen. But our expectation of the curve steepening, because we stayed away from that back end of the curve, is also because we really thought that short end was going to start to come down, because as you mentioned, we're looking at it more in a disinflationary standpoint, over the next several months. We don't think the Fed is going to hike, so that curve should steepen. So the market was caught off guard, if I should say a bit. And because of that, you saw this large shift in that back end.
Leslie, I was reading through your most recent blog from the beginning of, or sort of the end of July, and you were talking about how you had this sort of what-if scenario if the Fed does hike, right? And so I know that there's a lot that we still don't think at CIO, as you reiterated, that the Fed is going to hike, not this year anyway. But given that, the what-if scenario, the unknowns that we have ahead of us, and the fact that we still believe that high-quality fixed income holds a place in any portfolio, where do you see the biggest opportunities right now in fixed income, and what should investors actually be paying the closest attention to? Because there is so much going on between the Fed, the markets, what's going on in geopolitical conflicts, a lot to digest there.
Yeah, and I think Anthony, you bring up a really important point. And here's something that we saw from the July FOMC, right? They would label they're sort of like the Q&A as dovish, right? But did dovish lead to a decline in interest rates? It didn't. But interest rates rising. And I think the question becomes as to whether or not, and again, we have the employment number on Friday. We have to see not only what the unemployment rate does, but how that wage inflation starts to play out. So we don't have a big spike in wage inflation. But the point is, even if they did hike, and again, that's not our view, doesn't mean interest rates are going to go up. They could come down. And we also have too, and Anthony, I think is an important point. There's two different sort of roles here between Treasury Secretary Bessent and Chair Warsh. We have the refunding announcement out later today that's going to talk about the refunding and the Treasury supply over the next quarter. And we know the deficit is not necessarily falling. So I think you have that sort of push me, pull me there. Also, too, in the longer term, we do think that interest rates will come down by the end of the year, right? But if, in fact, we have sort of this continued inflation or reacceleration of inflation, then that's going to cause an issue to more of that back end. And because of that back end volatility, we really like staying in that short to intermediate part of the curve. That really hasn't changed. We've diversified in terms of our fixed income allocation because we can add things like high yield to attractive. You get over 7% yield. It's high quality, not a lot of interest rate risk. And we're all about that compounding income right now. And one of the things that we wrote in that piece, we talked about with this what if scenario, is that what's different today in a lot of these other scenarios that we do have this income that we haven't seen in well over a decade, right? So the market can withstand higher rates a little bit more. It can stand some wider spreads because we're still in historical tights, but your total return is really going to be driven by this compounding income. So we stay with the higher quality, mostly securitized product over corporate credit, like agency MBS and CMBS, which has done actually much better than we've seen in corporate credit because of the supply and investment grade corporates. But we want to stay high quality. We have some high yield to get that sort of that income or that carry, if you will. But we still stay in that short end of the curve because there's a lot of unknowns in that back end, and we simply don't want to or need to take on that kind of volatility.
Right, and just to kind of round it out, duration, you still think duration is attractive compared to, some of the credit sectors and of the overall equity market, right?
Listen, duration's cheap. Interest rate risk is cheap to both the equity market and the credit market. We just don't want to extend too far out right now. There will be a point in time where we do, but you just have a lot of volatility. So if you want to add interest rate risk, which we think that there's not a problem with doing that, you want to stay with that 2 to 5 year area of the curve. But there's no question that risk is cheap to equity and fixed income.
Excellent. Leslie, thank you. Always a great conversation with you. And we were just kind of joking around about it, that this has been quite a busy year for the markets. And we're just about past the halfway point. So lots more to go. Look forward to more conversations with you. Thank you, Leslie. Good to see you.
You too.
Great. And for more information from Leslie and the rest of the Chief Investment Office, please visit our website at ubs.com/views. Plus, you can follow UBS on social media. We're on LinkedIn and Facebook. Plus, the studio has its own Instagram channel. You can follow us at UBS Trending. Lots of content there for you to peruse. And if you have any questions about your portfolio or whatever Leslie and I spoke about today, we hope you continue this conversation with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. See you soon, everybody. Thanks.